This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our introductory lectures, we got introduced to all of the different taxes, those of the person, income tax as we see here in Chapter 2, CGT that we'll see later, and finally, sadly, of course, inheritance tax. We also got corporate tax and VAT. And every one of those taxes, including indeed even national insurance contributions, every one of them comes effectively in two parts. Here within the income tax computation, we'll see our first illustration of that. The two parts are, we must firstly, in part 1, compute what is chargeable to tax. Here in income tax, a taxable income figure, made up of all the different individual figures of income that an individual might have in a given time period, a time period as we'll see, which is a tax year, more of that in a moment's time. And we list them out. And we list them out to compute taxable income. That's part 1. Now there's a whole lot of work that lies beneath that surface. For each of those sources of taxable income that we have, whether it be employment income, probably the most likely, of course, for any individual in the UK, whether it be from the self-employed, a trading profit, whether it's investment income, dividends, interest there, or even property income if you're fortunate enough to have a rental property. Every one of those must have its own rules by which we determine how much is the amount of taxable income for this particular period for which we prepare the tax computation, the tax year. So we put all those together. What we'll also discover in just a few moments' time is that every one of us each tax year, depending on exactly how big our figure of income is, we may benefit from something called a personal allowance. Now, the personal allowance is quite simply a level of tax-free income. Not a number, thankfully, that you'll have to memorise, though I think by the time you hit the exam room, you probably will know it. It's one of those many, many figures given to you on your rates and allowances tables. You deduct that in deriving your taxable income. So that's the first part. The second part of the computation is, of course, having computed what is chargeable to tax, the taxable income, we then got to calculate the tax thereon. And the first such figure of tax to be computed is what we will call, and we'll see in the pro forma computation in a moment, the tax liability. Once we have that tax liability, and frequently that is all you have to compute, read the questions requirement very carefully, but there is also a possibility that you may have to extend on for one small further calculation and calculate income tax payable. So, two parts of any computation. Finding out first of all what is chargeable to tax and then computing the tax thereon. Here in income tax, taxable income, and compute mostly the tax liability, possibly in addition the tax payable. In corporate tax, we'll calculate for a company a taxable total profit for a given period, there the accounting period. And having got that taxable total profit, we'll then compute the corporation tax liability. The only main difference between what we see there in corporate tax and what we see here in income tax is that the calculation of the tax is a whole lot easier in corporate tax. There is one rate of taxation in corporate tax that is applicable across the board, whatever level of profit you have. It's a simple single calculation. I hate to tell you this, but it's not that simple when it comes to income tax. As we will discover, there's a range, as we've just said, of different sources of income. And some of those sources of income are categorised into categories that will have their own separate rates of tax. And as we'll discover, it is a progressive taxation, something you may have read about in Chapter 1. A progressive taxation. What that means is that as the level of taxable income increases, as you go above certain bands of taxable income, then the rates of tax will increase. We have, for most, we'll come to call it non-savings income, but stuff like your employment income, for example, we have what we call a basic rate band that is currently, and has been for some tax years now, 20%. But you go above the basic rate band in terms of your taxable income, and it doubles to 40%. you have to have a lot more before you then go into what we'll call an additional rate band, where it moves up not too much more, but to 45%. But there is that huge difference, that step up in terms of your income when you go from 20% to 40%. And those bands of taxable income and the tax rates applicable to them are again all given on your rates and allowances pages. You won't have to memorise them, but you'll have practiced them so often by the time you hit the exam room, you won't have need to look at them. So, as we've said, and as we now see here in the notes there in front of you, in the introduction, there are two main parts to our income tax computation. Firstly, calculating the taxpayer's taxable income, and then calculating, as usually, the income tax liability, and or they might ask you to go to income tax payable. We'll be mentioning this a lot as we go through. We may already mention indeed in the introductory lectures. But when dealing with Section A, objective testing questions, it's essential that you do read very carefully, not just the information in the question, which of course we always do from day one of ever taking exams, but the requirement. The requirement is critical. In terms of an objective testing question, remember, you either get 2 marks or you get no marks. And there will be 3 answers in there that you could compute as part of a process, or if you get a mistake. One of those is a misinterpretation. Does it ask you to calculate taxable income? Does it ask you to calculate tax liability? Does it even ask you to calculate prior to taxable income something we'll call net income? Does it ask you to calculate tax payable instead of tax liability? So be careful to read a requirement very, very, very carefully indeed. So many times on Ask the Tutor questions that if you have a need to, please utilise, that I see questions where students are, where does this answer come from? Why is it this and not this? And it's simply because the student has misinterpreted the question. Look at that requirement, then look at the information, making certain that you've understood the real meaning of that requirement. More of that as we go through. Now then, we said that our taxable income is going to be made up of a variety of different sources of income. And we've got to split that on our income tax computation into potentially up to 3 categories. So here we go. The taxable income will need to be divided into 3 possible analysis columns. Now, you won't, every time you start such a question, set up 3 analysis columns. You will, as we've said, having read the requirements, read the information in the question, and see which of those columns are relevant to you. And we'll only use those which are relevant to us. So 3 possible analysis columns. Well, there's one obvious one, dividend income. Very specific, just dividend income. We've then got a term we won't be familiar with, savings income. But that's simple. That is interest income. And we'll talk later about where those sources of interest may have come from. The obvious one, firstly, in our heads will, of course, be from money in the bank. You've got a deposit account there, a savers account, and it earns interest. Probably not a huge amount. Most of course, when it comes to banks and interest, we pay them on overdrafts rather than they pay us. But if we do have such interest income, it is called, for purposes of our income tax computation, savings income. And then everything else, which is simply known as non-savings income. Now, everything else is going to be made up of probably our main source of income for most taxpayers, employment income. That's for the employed, for the self-employed, trading profits of the self-employed, and also, should you have it, property income. So the first thing you're going to have to do is to learn and understand the structure of the income tax computation. Be able, after we've seen it in a few minutes' time, to then close your book over, or on the bus going to work or whatever, or while you're in the shower, you can either, well, probably not write down in the shower, but you could talk through, right, what's the content of the income tax computation? What goes where? What are the analyses? So it becomes second nature to you. Easy. Now, as we've already said, In computing the taxable income, UK taxpayers may be entitled to a deduction of a personal allowance. Now there it says may be, because what we will see later in this chapter is that you reach a certain level of income, a figure we'll call adjusted net income, where if you go above that level, you don't immediately lose the entirety of the personal allowance. You start to lose it progressively. You will then reach a certain higher level of income, where by that point the personal allowance has been reduced down to zero. But more of that later. Vast majority of taxpayers are not in that level of income, and therefore we will all enjoy a personal allowance. Now, it's a level of tax-free income that we're entitled to. The details of this are in section 3 of the chapter as regards the reduction in the personal allowance especially. But our normal personal allowance available to us for our 1920 tax year is £12,500. There's a standard deduction, again given to you on your rates and allowances page. In discussing the structure of the exam itself, we saw it was split into 3 sections, and only in section C did we get into that beautiful word or term, constructed response, the traditional written answer to a question. And there, one of the 2 biggest marked questions on the paper, one of the 2 15-mark questions, is given over to income tax. Now, it is perfectly possible, and happens on a regular basis, that they're going to ask you to prepare in there an income tax computation. It doesn't always happen. What it might be is focused on one particular source of income that goes into the income tax computation. And almost certainly, if it is to be that, it's going to be either employment income, there's a whole range of different issues to deal with, or it's going to be trading profits of the self-employed. But that income tax computation, in some way, shape or form, some issue pertaining to it, is going to be the 15-mark question in section C. At this stage, we need to make sure we know how to put that computation together. Now then, we mentioned briefly a moment ago that, of course, when we prepare an income tax computation, it has to be prepared for a given period of time. Now, that period, of course, will be a year. When accounts are prepared, they're usually prepared for an accounting year. Only there, the business, whether it's unincorporated trader, sole trader, partnership, or incorporated trader, a limited company, they get to choose what particular accounting date will be their regular normal accounting period end date. We'll have accounts for an accounting year ended. We don't get to choose in tax the time period for which we will be charged to any individual tax. And the 2 main personal taxes, income tax and, as we'll see later, capital gains tax, or CGT as we will know it from now on, those computations are prepared for a tax year. And a tax year runs from and to some very strange dates indeed, as we'll see in these notes here. Prepared for each taxpayer, and indeed each and every taxpayer has an income tax computation. From the day we're born, we exist separately and independently in terms of our taxes, and therefore each and every one of us will be required to prepare an income tax computation if, of course, we have taxable income. And it is prepared, as we said, for a tax year. Now, here's the strange dates. The tax year runs from April the 6th through to April the 5th. Our tax year, for which we are using for purposes of the 2019-20 exams, is 2019-20 tax year. This, of course, relevant for the exams from June 2020 through to March of 2021. Now, that tax year, as we see, runs from 6th of April to 5th of April, so it is from the 6th of April 2019 to the 5th of April 2020. Now, herein lies the problem. Our different sources of income don't always relate exactly to that time period. For an example, an unincorporated trader. As we've just said, a business can prepare accounts to any date they choose. And if it is a profitable business, which in most of our examples it will be, but not all, then we have to compute an adjusted trading profit for that period. But not all accounting periods are the year ended the 5th of April. So we must have some way, we call it a basis of assessment, by which we relate any given accounting period to the tax year. And that follows through on every source of income, whether it's employment income, whether it's dividend income, whether it's interest income, whether it's property income. And most of those sources, everything other than trading profit effectively, it's actually a pretty simple basis that we use. We simply look for 1920, 6th of April 19 to 5th of April 2020. We quite simply look at what amounts of income were actually received in that tax year. That is our main basis of assessment that we'll see. The principal one where it isn't, and it gets a little bit trickier, is the trading profits of the self-employed. But that's for later in our studies. So we need to determine a basis of assessment for each source of taxable income and then include those sources on here, as we see it, our pro forma income tax computation. Now here for the 1920 tax year, what are we suggesting we might have? Well, basically here, everything. We've got everything you could possibly see. Now you remember, we divided up our sources of income for purposes of this computation into 3 categories. The order that we must always show them in on this computation. Firstly, non-savings income. Now that was simple. It was everything other than savings income, which is interest income and obviously dividend income as well. So non-savings, as we'll see here, trading profit, there it is, employment income, there it is, property income, there it is, in that column. We said we had dividend income, dividends into, surprisingly, the dividend column. Different sources of interest. Now, the one we said a moment ago that we're mostly familiar with, across the world we'll be familiar with, will be bank interest. And there we go, bank deposit interest, savings income. We may also have, and it's a bit of maybe a unique scenario for the UK, something called building society interest. Now, again, you don't have to worry what it is and what it does. It's a financial institution. And any such interest that comes in is again chargeable to tax and is therefore classified as savings income. We mention here other interest. Yeah, interest income is quite interesting in as much as there are different types. We see there bank and building society interest, but you get it from other sources, some that you may be familiar with already. For example, corporate bonds, debentures, loan stock there. If an individual owns such, it has interest. Interest will be received thereon. So we might have corporate bond or loan stock interest. And of course, there are government securities, interest-bearing government securities. So any of those are sources of interest income that may be chargeable to income tax. Now I say may there because what we'll discover is that there are certain sources of interest, not to worry here, not too many of them, that are actually exempt from income tax. Now we will see that list of exemptions a little later on in this chapter, but that's what makes savings income, interest income, a little bit more, dare I use the pun, interesting there, because we've got different types of taxable interest income, and we've also got a few examples of exempt income. So again, a typical objective testing question, giving you a list of such sources of interest income and asking you to compute how much of that savings income will be chargeable to tax, giving you different dates when interest was received. We pick out what was received in our tax year, 6th of April to 5th of April, but also throwing in the odd example of exempt income, which of course we must exclude. Okay, so we've got our categories of income. We analyse them in those three forms, and we'll also keep a total column running here. Now, again, I happen to have put the total column at the end of those columns. On some exam material providers, you may see that total column as the first column. It doesn't matter. You can choose what you will there. But again, I prefer to run that at the end. What you'll also see on here is that next to and beneath, indeed, the trading profit, we've got that one. Trading loss reliefs. It is, of course, a sad fact that just because you go into business as an unincorporated trade or as a partner in a partnership, it doesn't guarantee that for every accounting period in which you trade, you actually make a profit. Remember, here it's going to be a profit as adjusted for taxation purposes. There are rules there, they're contained in Chapter 4. That's a very important chapter because adjustment of profit work will always be examined in some way, shape or form in your exam, where we discover that not all expenses that the business incurs are necessarily allowable for taxation, and not all sources of income that go on to that statement of profit or loss for the business are necessarily trading income. There might be property income, there might be interest income, for example, and those, as you've just seen, are separated out and shown independently upon this income tax computation. So there is work to do there. But after doing that exercise, you may end up whereby it's actually not a trading profit, but a trading loss. So here, at least a little bit of good news in relation to the bad news that your business has made a loss. And, pardon me, the good news is that if they're going to tax us on profits, then they have to give us reliefs for losses. And one of those possible loss reliefs is that if a business made a loss that it was not able to immediately relieve, or we chose not to immediately relieve it, it was carried forward. When it is carried forward, as you'll see here, there is one thing that it can go against in the future, and that is future trading profits of the same trade. So that's why here on the computation, you see this trading loss relief, this brought forward loss, being deducted directly from the one source of income that it is deductible from, trading profit for this period. Now that's one possible use of the loss. Don't worry, we've got an entire chapter dealing with the trading loss reliefs. I'm just introducing you to, I say interesting you in, probably not, I'm introducing you to here some of the other issues that are relevant in relation to trading income and indeed then impacting on the income tax computation. Now that was if we had chosen not to or were unable previously to relieve the loss. If we come down the computation, we've listed the sources of income and we get total income. Again, read a question as regards what it asks you to compute. Probably not that likely that they'll want total income, but that's what it is. And it's before certain deductions. And one of those categories of deductions, I've just called them here other trading loss reliefs. And they go against total income. Now again, chapter 7 is the chapter that deals with loss reliefs there. But if you had, for example, up here, instead of a trading profit, a trading loss, one of the things that you will learn is where there are losses on any source of income where losses could arise, trading is the most obvious, you do not put a negative figure for the assessment into the computation. if the figure for this year was a loss, you would put nil in as the assessment. What you then get to do is to choose which of the available trading loss reliefs you wish to use. One of them, as we've seen, is to carry it forward, where there it would indeed be a bracketed figure. It would be deducted from the trading income of this period. Clearly, if the loss itself is of this period, there is no loss brought forward, but it is actually this period, then it is a nil assessment that goes into this year's income tax computation. And then one of the possible other reliefs is down here. One of these other trading loss reliefs is indeed to set it off against the total income of this tax year, to set it against the total income of the tax year. Now then, having then got, one other one, qualifying interest. Having got the total income, made the deductions, we'll talk about what forms of interest are qualifying a little later. It's very, very few. Most of us, of course, pay interest on, say, a mortgage to buy our property, a loan to buy a car, on our credit cards or whatever it might be, or overdraft interest to the bank. None of those sources of interest payable, I'm afraid, are going to give you any tax relief at all. There's only very, very specific and very few sources of interest payments that will qualify. We'll see those later. But we then get a figure, separate figure of income known as net income. And we're not quite there in completing this first part of the computation, because now we deduct our personal allowance. Our personal allowance is to be deducted, and that is usually £12,500, and we deduct that personal allowance from our total of our net income. And as with these other trading loss reliefs here, we make the deduction firstly from non-savings income. Firstly from non-savings income. But look at the note down here. Deductions from total income and the deduction of the personal allowance from net income are deducted in a specific order. Now, it is usual that what we'll find is that the non-savings income will be big enough in its own right to absorb the personal allowance, which is our maximum, our normal £12,500. But the deductions of the loss reliefs and qualifying interest are from total income and the personal allowance from net income. So what it means is the order is firstly non-savings income, which, as we've highlighted, you see there. But then if either the loss reliefs or the personal allowance was bigger than the figure of non-savings income from which it is deducted, we then would go across to our savings income, and unlikely though it is, if the remaining loss reliefs or personal allowance were bigger than the figure of non-savings income, finally you would come to dividend income and deduct it there. So that's our order of set-off. Non-savings, followed by savings, and dividend income. I say there for purposes of this exam. It is possible, and you may go on to see that at advanced taxation, that you could, at your choice, change that order to improve the position for you, the taxpayer. That is not an issue within our examination there. So there we go. We have our pro forma income tax computation. What I want you to do between now and next time is to make sure that you've learnt the structure of that computation. You know the categories of income, non-savings, savings, and dividend income. You know the structure of the computation. We tend first to list out our earned income, be that employment income and or trading income. We then list out our sources of investment income, property income, interest income and dividend income. It doesn't matter, by the way, what order you list them out in. But again, subject to what sources of income you have, that determined what columns you set up here in deriving your total income. List out earned, unearned, put the figures of such income into the total column and into the relevant analysis column, come down to total income. You can always then cross-cast to make sure that your individual three figures add up to the total. Take away, if there are any, sources of trading loss reliefs or qualifying loan interest. Get net income, which you'll definitely always have to show, net income, and then deduct from it, which you will routinely do. Only one situation to see later where we restrict or remove the personal allowance, but otherwise the personal allowance of $12,500. In order, as with the deductions of losses and qualifying interest, from non-savings, then savings, and then finally dividend income if necessary. And that gives you the completion of the first part of the computation. We now have our figure of taxable income, and that's a huge part of the problem complete. Once we have our taxable income analysed in these three forms, we'll then be able to compute our tax liability. If necessary, go on to tax payable. But to be able to compute that first figure, and usually required figure of tax liability, we need to have not just the total amount of taxable income, we need this analysis. Because as I said to you earlier, which you may or may not remember, our different sources of income may have different rates of taxation applicable to them. That, along with many other things, we will see in our next session together.